Welcome back to the channel. I'm Ehsaan from Spectrum CPAs. And on this channel, I make Canadian tax make sense for business owners. And today, I'm answering a question I get more than almost any other. Should you incorporate? Here's why this matters so much. Everywhere you look online, somebody is telling you to incorporate to tax. And I'll be straight with you. For a whole lot of Canadians, that advice is just flat out wrong. It doesn't save them a single dollar. It just piles on costs, paperwork, and complexity. So in today's video, I'm going to give you the real break even. How to actually know whether incorporating will save you money or whether it'll just make your life more complicated. And make sure you stay to the end because I'm going to give you the two specific situations where I tell people straight up, do not incorporate it. Let's dive in. The first thing you need to wrap your head around is the mindset shift. Incorporating does not erase your tax. It defers it. Remember that phrase, deferral, not savings. When you leave profit inside your corporation, it's taxed at a low rate right now. And you only pay the personal tax later when you take the money out. But, and this is the part people miss, if you pull all of it out to live on, pay both layers of tax anyway. And that savings everyone promised you disappears into thin air. So forget the magic income number people love to throw around. Just incorporate once you hit 100 grand. I don't use a magic number, and neither should you. I use a 3-question test. Question number 1, what's your marginal personal tax rate right now? That's the rate on your next dollar of income. Question number 2, how much of your income do you actually need to withdraw to live on? Versus how much can you actually leave inside the company? Question number 3, what will your realistic annual accounting and compliance costs actually be? And I mean a real quote from an accountant, not a guess from the internet. Here's the rule. If the tax deferral you get is bigger than those costs, then incorporating probably makes sense for you. If it's not, it doesn't. Simple as that. And you need to know what actually changes when you incorporate. Because it's more than a tax move. You become a separate legal entity. You file a T2 corporate tax return every year on top of your personal one. You might need a payroll account and an HST account, and you take on real bookkeeping and filing costs that you didn't have as a sole proprietor. So this is a genuine business decision, not a magic button you press to pay less tax. Now let me make this real with some Ontario numbers, because this is where it clicks. Let's take a sole proprietor earning $100,000. They pay personal tax the whole way up a marginal tax rate of around 31.5% at that income. They walk away keeping about $68,500. Now, let's run that same $100,000 through a corporation. The company pays a small business rate. Now, here in Ontario, as of July 2026, that's 9% federal plus 2% provincial, so about 11.2% combined. On 100 grand, that's $11,200 in tax. And the company retains $88,800. So on paper, that's a $20,280 advantage. Sounds amazing, right? And by the way, Ontario just bumped that small business limit up to $600,000. So there's even more room to play with. Hold that thought. But here's the catch, and this is everything. You only keep that $20,000 advantage if the money stays inside the corporation. The moment you pull it all out to live on, you pay personal tax on the way out, and that gap closes right back up. So the corporation only wins if you can actually afford to leave the money in it. Let me say that again, because it's the whole video. The deferral only helps if you don't need the cash. Let me give you 2 quick real-world pictures. Owner number 1 runs a consulting business. That's $180,000, but only needs about $90,000 to live on. She can leave a big chunk inside the company every year. Incorporating is a clear win for her. Owner number 2, that's $90,000 and needs basically all of it to pay his mortgage and feed his family. For him, incorporating just adds T2 return, bookkeeping bills, and headaches. For a deferral, he can't actually use. Same advice, 2 completely different answers. That's why the number alone means nothing. Now here's some other information that's really important to know. 2 things people get badly wrong about incorporating. The first is liability protection. Yes, a corporation gives you liability protection, but it is a lot narrower than most people think. It does not cover debts you've personally guaranteed. And here's the reality of small business in Canada. Most business loans, most leases, most lines of credit, the bank makes you personally guarantee them. So this idea that the corporation is a magic force field around everything you own, that's a myth. It protects you in some situations, but not the ones people assume. The second, and this is a big one, is the personal service business trap. If you really work like an employee for one single client, the CRA can reclassify your company as a personal service business. And if they do, it is brutal. You lose the small business deduction entirely. You pay the full corporate tax rate plus an extra 5% on top of that, and you can only deduct a very limited set of expenses. And this is not theoretical, it is happening right now in the trucking industry. After the CRA lifted its enforcement moratorium in 2025 with a new requirement to report payments over $500 to a corporation on a T4A slip. And I'll tell you my honest prediction. I expect that same enforcement approach to spread to IT, to construction, and to professional services next. That PSB trap is so important and so common that I made an entire separate video on it. If you have one main client, I want you to watch that one next before you do anything. But first, if you're sitting on the fence about incorporating, please don't guess your way through it. My team at Spectrum CPAs will run your actual numbers and tell you honestly whether it pays for you or not. There's a link in the description to book a free call. Okay, let's hit your questions. This one's from Wei, and honestly, it's the question. Ehsaan, at what income should I incorporate? All right, Wei, let me give it to you straight. There is no single number. It always comes back to 3 questions. Your marginal rate, how much can you actually leave in the company, and your real annual costs. For a lot of owners, it starts making sense once there's meaningful profit they can leave inside the corporation to grow. But if you need every dollar just to live on, then honestly, hold off. You're not ready yet, and that's okay. And here's the second one. This one's from Fatima. She asks, can I just incorporate later once I'm bigger? Yes, Fatima, and this is actually the smart way to think about it. You can start as a sole proprietor and incorporate when the number finally justifies it. There are even ways to roll your existing business into a corporation tax-free when that time comes. So don't rush it. Incorporate when it earns its keep, not before. So, should you incorporate? Only if the deferral beats the cost, and only if you can actually afford to leave money inside the corporation. If this video cleared it up for you, do me a favor. Hit like, subscribe, and send it to someone who keeps getting told to just incorporate. I'm Ehsaan from Spectrum CPAs. I'll see you on the next one.